We also suspect, and the rhetoric has very much confirmed this, that other countries will respond with tariffs of their own. So we have this situation. I have no doubt at all that the EU will do just that. The UK is sitting on its hands trying to pretend that there is a special relationship. We have been treated better by Trump with 10% tariffs as opposed to the EU, which is, I think, 20% tariffs. And consequently, we just don't want to shout about our position too much because we don't want to upset President Trump. So, but going back to the point, the combination of a credit bubble bursting and tariffs on top were what drove Wall Street down from the highs.
Alasdair Macleod, good afternoon to you, my friend. How are you?
I'm very well indeed, thank you.
So quite the interesting day today. We had Trump announcing or coming out with the tariffs. A lot of volatility. I think that's created short-term, at least, volatility in the marketplace. I want to get your opinion and comment on that, but also in the broader picture, I don't know how much has really changed. You have an economy that's slowing here in the US. You have Europe that seems to be falling apart, and you have gold ripping, and the central banks are in a box. A lot there that I just threw at you. But start giving me your thoughts.
Well, which one do you want me to tackle first?
Let's start with today. It's a bad reaction in the markets here.
Okay, well, let's start with that. I mean, I've been writing for some time that the real danger is we are in the largest credit bubble in history. And if you don't believe it, just look at the debt. Ask yourself, are we in the largest debt bubble in history? And I think undoubtedly you will tell yourself, yes, we are. The point about debt is the other side of debt is credit. Debt equals credit. So if we're in the largest debt bubble in history, we are in the largest credit bubble in history. Credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. On top of that, we have tariffs. The tariff agenda is lethal as far as the credit bubble is concerned. It is exactly the same dynamic that we had in 1929 to 1930 when we had the popping of the roaring 20s credit bubble. We had the Fed, it was the first decade of the Fed with Benjamin Strong. And he believed in if you like, credit expansion to drive the economy. So, that's not too far different from current beliefs. On top of that, we had the Smoot-Hawley Tariff Act, which increased tariffs by an average of about 20% or slightly more. Now, in those days, I understand that consumer goods imported from abroad accounted for no more than 2 or 3 or 4% of total GDP. This time it is different. It is considerably more. The consequences of Smoot-Hawley Tariff Act Mark II are considerably greater than first time round. Not just because of the increased volume, if you like, of imported goods into America. Also, we have supply chains across the world which are affected by this. We also suspect, and the rhetoric has very much confirmed this, that other countries will respond with tariffs of their own. So we have this situation. I have no doubt at all that the EU will do just that. The UK is sitting on its hands trying to pretend that there is a special relationship. We have been treated better by Trump with 10% tariffs as opposed to the EU, which is, I think, 20% tariffs. And consequently, we just don't want to shout about our position too much because we don't want to upset President Trump. So, but going back to the point, the combination of a credit bubble bursting and tariffs on top were what drove Wall Street down from the highs in September 29 to the lows in 1932, middle of 1932, whereby the Dow lost nearly 90% of its value from top to bottom. And on top of that, we had about 9,000 banks going bust over that time and following that time. And, people say, well, the problem with the reason we had a depression was because of the contraction of money supply. What they failed to understand is the reason that money supply contracted was because banks went bust. It's the only way in which bank credit gets removed, if you like, from the economy, by banks going bust, or alternatively, people who owe debt to the banks going bust. Then it gets wiped out. It's as simple as that. But until then, what happens, and particularly since we don't have a gold standard of any sort, is that credit just gets passed on. But that's a slightly separate, I'm going off topic going in there. But the point to understand is that we have a combination of the largest credit bubble in history going pop and Smoot-Hawley Tariff Act Mark II, courtesy of President Trump, at the same time. Exactly the same dynamics, but worse than we saw between 1929 and 1930.
Oh, wow. That is
I'm sorry to say, I wish I could say something different, but that is the point. That is the point. And that's why, we're seeing today, I'm just looking at my screen here, we got, the sort of NASDAQ down 5%, and we've got, all these things are just falling apart now. And the idea that this is a sort of little bit of turbulence and don't worry, it'll sort itself out, I don't think so. And we can also talk about interest rates if you want to come onto that subject at some stage.
Well, yeah, let's do that. I do have a couple of other questions that you just said. So, but let's go to interest rates first. But in the broader scheme, you brought up a great point of somewhat, what does this mean for the UK? I'm very interested in that, and it's obviously not good, but I want to work that out a little bit more. And also just with Europe, is this, I'm going to be dire here, but is this like, and I don't know exactly what this looks like, but is this the breaking apart of the EU, or potentially that?
I think potentially it is. But I think that's probably a little down the line. I think there are probably more immediate things we should be discussing than that. If you look at the UK, the main members of the EU, with the exception of Germany, we're all in debt traps. Now, basically, a debt trap is where the government debt increases at a faster pace than the revenue that it gets in. Yep. If we go into recession, slump, depression, whatever you want to call it, tax revenues drop, welfare commitments rise, budget deficits increase. So you have this situation where tax revenues are decreasing, but the creation of debt is increasing at a faster rate. In other words, we have a debt trap, okay? Now, so you've got to think, what are the foreigners going to do with you on a debt trap? Now, whether it's you in the United States or you in France or you in the UK or whatever, it's all the same thing. They're going to look at this and they're going to say, hold on a minute. There is a lot of risk in me holding this currency. This currency is going down. This sucker is going down. Do I really want to hold it? And the answer is no. And that's why we're seeing central banks buying gold. I think the point to understand is that what central banks are doing is not buying gold. They're getting the hell out of credit. That's actually what they're doing. They realize that there are increased risks holding fiat currencies. So they are adjusting their reserves to reflect their perception of that risk. And this is something which has only just started, in my view, because really, another way to put it is that you could say that, paint great pictures and say, well, we had Bretton Woods. That was chucked out in 1971. We then had the fiat currency era. That's now coming to an end. We're now going to have a new monetary system, which will replace the fiat currency era. question, what is that going to be? Answer, we don't know. And it's particularly difficult because the whole of the West is stuck, if you like, on the idea of macroeconomics, neo-Keynesianism, the idea that the government has got to continue to stimulate the economy for the economy to grow. What is economic growth? Well, it's a complete non sequitur because you can grow the economy, but the GDP number is basically the amount of credit which there is in the system. It doesn't tell you what that credit is doing. So actually, the problem we have is that the guys monitoring this, their use of statistics and all the rest of it, is completely useless. They don't understand economics. They don't understand what they're doing. So how they're going to come up with a new system when they don't actually understand what they're talking about, this is going to be an interesting development. So, and I would like to mention something else. We see that central banks are selling dollars, selling euros in particular, and for all I know, selling sterling. They should be selling sterling, selling yen to buy gold. Okay. Gold is, if you like, their safe haven. I can understand that. I think we should all be able to understand that. But what does this mean for interest rates? Well, if you have a heightened risk in a currency, then quite obviously, by risk, what I mean is a risk that it will lose purchasing power, then the interest rate, which you as a foreigner would accept, if you like, to continue to hold that currency, should reflect your view of how the purchasing power of that currency is likely to go down or up or wherever it might be. There is absolutely no doubt that anyone holding a foreign currency is looking at that foreign currency and thinking, I'm not going to get as much real value, if you like, in a year's time as I have now. So the idea that the Fed can reduce interest rates, for example, and manage the economy and all the rest of it, and even sort of reduce interest rates so that all the zombie corporations who would go bust with interest rates of, say, 4, 5, 6, 7, 10% are miraculously rescued. That's not going to work, because what will happen is that the foreigners won't hold your currency. They'll sell it. And that's what we're seeing today. I think the dollars trade weighted is down 2% or slightly more than 2% in one day. This is a major, major move. Mm-hmm. So, how do you counter this? Well, the answer is you've got to have higher interest rates. Interest rates are compensation for risk. It's risk at loss of value. And this is a point that nobody seems to understand. They seem to think, and this is Keynesian groupthink, basically. They seem to think that if we go into a recession, then interest rates go lower. No, they don't. Interest rates have got nothing to do with recession or growth or whatever. It is far more to do with the anticipated purchasing power of the currency, let us say, in a year's time. So if the anticipation is that the currency is going to lose more value, let us say, than the market expects, then interest rates are going to go up. Bond yields are going to go up. Nobody's going to lend you money, particularly if you're in a debt trap, anything like current levels. And as to the point, we had exactly this problem in 1976 in the UK, because, first of all, it started with the sterling crisis, and the Americans came and bailed us out. They bought sterling, drove it up, and then they sent in the IMF, who, of course, they controlled and they still control, sent in the IMF basically to get their money back. And the IMF forced the UK government to do something about their spending. And left-wing ministers were resigning left, right, and centre, Michael Foot being the most prominent one amongst them, Tony Benn being another. They couldn't take this cut in public spending being, basically somewhere between socialism and communism. But the point is that at that time, gilts were issued with coupons in excess of 15%. They were yielding as much as 16%. I can remember the 15.5s of 98. This was issued. I think it was in either 1975 or 76. So, that's the proof that if you've got a currency risk, then, nobody is going to lend you any money at all, any credit. Nobody's going to give you any credit unless the return is there to compensate for the risk. And here we are now going into debt traps. Where's it going to stop? Don't ask me. I think it's going to be a lot higher than current levels. So what we have seen today in terms of shifts within the market is we've seen a sort of developing collapse in equities as the bubble pops. At the same time, bond yields have fallen quite heavily, I think because of this neo-Keynesian misconception, partly, but also in anticipation of investment managers rebalancing their portfolios away from risk into what they perceive as no risk, the regulator will tell you that US Treasuries are no risk at all, which of course is a complete nonsense. But as if you're a fund manager, if you're an investment manager, this is the sort of thing that you consider. So, we've got markets beginning to anticipate a rebalancing of portfolios, which basically is going to undermine equities even more. But there will come a point where the perceived benefits to bonds in terms of falling yields are going to be reversed when people do this double take and say, hold on a minute, what does this mean for the dollar? What does that mean for interest rates? And then you will find that yields will start rising. And that will be, if you like, the second knock on the equity market. And this is what happened. I mean, this basically is what happened way back in 2930. You had the initial fall. You had, sort of Black Monday, Black Tuesday, whatever. You had the fall, really dramatic fall in October 29. It then steadied from, I think, early November through to around about, from memory, something like May, 1930, around about then. And then it was, just a straight slide, just going down and down and down and down until the whole thing bottomed out in 1932, mid-1932. I can see that we can have an initial sell-off. I think we'll probably have some sort of consolidation. But then when people actually realize that, the consequences of the debt traps that everybody is in, I think at that stage it's really going to go, really going to go down. And of course, we don't, as far as the banks are concerned, we don't only have commercial real estate, but, there's an awful lot of equity, if you like, which secures their collateral. And, here again, you're going to get selling by the banks, forced selling by the banks in order to protect their own position.
Yeah. So all of that, you already answered my questions, but I'm going to ask them again, if you would.
Okay. Sorry about that.
Oh, don't be sorry. It was great, but I want to ask them again. So this is basically going to kill the bond market. That's the next thing to go, which kill the banking sector. Correct me if I'm wrong. That's what I'm going to have we're going to have more of a liquidity crisis, pardon me, which will also then in turn, which is already starting to suffer. We're seeing the signs in the US, the real estate market, which is where everybody's money is.
Yep. Well, of course, talking about real estate, I mean, I mentioned commercial real estate. The interesting situation is what's going to happen to the residential property market. And, there you're going to see mortgage rates rise and people will not be able to afford their mortgages. And not only that, but unemployment will be increasing. I mean, this is a hell. This is absolute hell. The political imperative is that the Fed, the US Treasury, and so on, and of course their opposite numbers in other countries, can't just stand there and watch this happening. They're going to have to intervene. And intervene they will. They will do what they can to, stop property foreclosures on people, et cetera, et cetera. So all that's going to happen. And all it'll do is just undermine the currencies even further. I'm afraid. I mean, what they used to do before 1929 to 1937, 8, whatever, was government took the view that, when you had this sort of credit cycle going pop, don't get involved, stay away from it. And for example, the post First World War depression. I mean, it was very sharp and very nasty. Lasted 15 months because government knew, don't get involved. Let them, just let people sort themselves out. And so what happened was the capital got redeployed from things that were going bust into things which were, might do well in the future. But the only people who could take those decisions were entrepreneurs who knew what the hell they were doing, not government ministers. And then Hoover comes along. He was I think, business secretary to Silent Carl Coolidge. Carl Coolidge said, that man is always giving me advice and all of it's bad, or something to that effect. And of course, he then became president following Coolidge, and it was a disaster. Then you had Roosevelt following him, and Roosevelt was doing exactly the same thing, sticking his nose into every bit of business, the New Deal and all the rest of it. He was just doing exactly, what Hoover had been doing before. So ever since that, you've had this government intervention. The government knows best. The government has this political imperative to make sure that nobody gets hurt, that make sure that, and of course, this is now sort of morphed into, we need to ensure that prices continue rising at the rate of 2%, so that consumers are encouraged to consume rather than save. I mean, come on. We have got a hell of a mess to sort out now. And this is, if you like, it is a 1 centuries old mess that's coming up to be sorted out. I mean, literally, this is potentially horrendous. I can't see how governments can stop it. I think anything they do will probably make it worse, or prolong it. And worse than that, I can't see that anyone in government has the first inkling, if you like, of basic economics. They think in Keynesian terms, they think in macroeconomic terms, which is complete non-science. It's a socialist ideal, if you like. We can manage markets. No, you can't. And I'm afraid that the time has come for us to pay for all these follies.
Yeah. So let me take us a little bit of step back here and kind of game this out. So we're getting this sell-off here in the liquidity. It looks like a liquidity crisis to me. I'm agreeing with you. And within a debt trap, let's say the Fed, and I'm not advocating this, but I'm just, again, trying to think this through and gaming out how it plays out. They start to buy the long end of the treasury, the 30-year, 10-year. What happens next? Is that when the currency does indeed implode there, that we get massive another round of inflation? Or,
well, inflation, I think, is actually a very bad term.
Okay.
Really, when you see prices rising, it's actually the purchasing power of the currency falling. And I have to say that as soon as the users of the currency realize that, the currency is doomed. I mean, the foreigners are the people to realize it first. So it happens in stages. And bear in mind that the US stock market, something like 14 or 15 trillion, depending on valuations, of equities are owned by foreigners. Are they going to hang around? I doubt it. They not only will sell equities, or try to, which will drive the market down, probably very quickly, but also they will want to sell their dollars because, if you're a foreigner and you're owning a foreign currency, then you've got risk. You've got risk because you're running a balance sheet in your own currency. So what do? You come back into your own currency. I mean, if you're a European business, okay, we know that the euro is absolute trash and all the rest of it, but a European business is running his accounts in the euros, and his risk-free position is to have euros and no foreign currency. Mm-hmm. So, this is what happens when you get, a recession, a slump, or whatever you'd like to call it. The idea that inflation is something, I think, is a complete misnomer. You've got to sort of think in terms of the purchasing power of your currency losing. It's your currency losing purchasing power. That's actually what it is. And if it was described as that, I think people would be a lot wiser about what the hell's going on.
And then we have gold ripping. It's really been ripping for, I was looking at charts the other day, and it's outperformed the S&P. I want to say the last 20 something years. But really it's ripped since 22, 23, and then recently since January, just made this monster run to over $3,000 an ounce in dollar terms. That's what gold is sniffing out, everything that you just said. And I guess that's my question. Is that what you would say gold is doing, is sniffing all of this out?
Yeah. I mean, it's going back to central banks. I mean, what central banks are doing is not so much buying gold as dumping fiat currencies. That is the adjustment they're doing in their reserves. And I think that is the point which one's got to understand. You've got to look at it from their point of view. Their point of view is actually quite simple. We're holding dollars. Dollars are going down. We don't want dollars. What do you buy? Euros? No. We've got some of those. Sterling? No. Yen? No. We don't want to buy any of those. We've got them. Basically, we see risk in the dollar-based fiat currency system. So we've got to hedge that risk by selling them and moving into real legal money, which is metallic with no counterparty risk, and that's gold. So that's really what they've been doing. And I think it's a process that will continue. And I think the thing to understand about gold is its purchasing power obviously fluctuates, but it doesn't fluctuate by very much. Certainly not as much as the purchasing power of a fiat currency. And if you look at prices, say 2,000 years ago, for many of the common goods that we need, and as humans, you'll find that the prices in gold are actually quite similar to the prices today. So, this is, if you like, I'm not saying that gold is a sort of wonderful, beautiful, and it's absolutely steady and there's no variation in its purchasing power whatsoever. But what I'm saying is that taking everything into consideration, it maintains its purchasing power over a long period of time. And if you look at estimates of above ground gold stock and how that has been increasing, it increases at roughly the same rate as the world population. So in other words, the human users of gold, not that they use gold, so we can come on to that in a second. The human users of gold basically find that gold is expanding at roughly the same rate as the population, and therefore there is a constancy in that. They don't actually use gold, they use credit. And this is a point which nobody seems to understand. What do we do with gold? I mean, we have gold coins, maybe. We might even have bullion. But if you look at in terms of coinage, then gold coins and silver coins are not the thing that you use first to pay for goods and services. No, it's the last thing. Gresham's law basically says that the bad money drives out the good. What's happening is that you spend the credit, if you like, which even on a gold standard is based on gold. It's linked to gold. And if you're worried about the value of that credit, then you encash it for gold coin. That's the way a gold standard works. And I think I really find it complete. It's just completely understandable that what's happening without any anchor, credit has no anchor to gold at all at the moment, that there is just huge risk in the whole system. And that is now coming true in the form of debt traps, in the form of government response to the necessary response, if you like, to any economic crisis, increased unemployment, whatever. They're just going to debase it further.
Yeah. So comment a little bit about, since this huge rise in gold price, and our thesis is that this is going to continue, especially more than likely accelerate. Are the exchanges in trouble?
Well, yeah, I think it's going that way. It's too soon to say they're in trouble. Of that, I'm certain. And I think the problem is that in the policy of suppressing gold and trying to drive it out of the system and trying to get everybody to accept that gold is no longer part of the monetary system, but the dollar is king and the dollar has replaced it. That attempt has involved the use of gold being leased, if you like, and then sold into the market, and the proceeds then invested in a carry trade to buy US T-bills. I mean, this was the situation basically in the 80s and 90s. And Frank Veneroso, who was a highly respected analyst at that time, looked into this, and he came to a conclusion that anything between 10,000 tons and 16,000 tons of central bank gold had been used for this purpose and sold into the market. And presumably, as I think he put it, was adorning the necks, wrists of Asian women. In other words, it had gone. Now, the point is that, when you talk about 10 to 16,000 tons of gold, I mean, roughly it's a third to a half of all declared gold reserves at that time, at the year 2000, round about then. After that, I think that the central banks got slightly wiser about it. And you then had what was called a book entry transfer system, so that the Bank of England would say, okay, we're leasing, we have the agreement from, say, the Bank of Finland to lease half their 30 tons of gold stored with us. And we agreed the rate and all the rest of it, but it's not leaving our vaults because it's got to be stored somewhere. So, what happened was that the trade moved from a carry trade into US T-bills into a carry trade to provide liquidity for the forward market in London and also other derivative markets, including COMEX. And that probably means that instead of gold disappearing, you've now got double ownership of an awful lot of it in central bank vaults, in the Bank of England and also in the Bank of New York. Sorry, not the Bank of New York, the Federal Bank of New York. And I mean, I think proof of this problem was when, 10 years ago, 10, 11 years ago, I think it was 2013, actually, the Bundesbank decided, first of all, he wanted to go and inspect its gold at the Federal Bank of New York, and we're told under no circumstances we will permit anyone look at it. They then tried to get their gold back, and obviously negotiations took place, which we weren't a party to, and they ended up agreeing, very reluctantly, I would think, to having 300 tons of their, I don't know how much, 1,000 tons or whatever it was, returned over a 7-year period, would you believe? Why is it so difficult to do this? And this was so embarrassing, actually, for the New York Fed, that eventually they actually, sent the whole lot back several months after this 7-year agreement was announced. And then we had the Dutch saying, "Oh, hold on, we got 1,000 tons over there. We better get ours back." And they got it back. Okay. I understand that the bar numbers on the Bundesbank's return gold didn't actually match their records. So this rather suggests that there's some funny business going on in the Federal Bank of, the Federal Bank of New York. So, this just shows the problem when you have double ownership of gold. It's fine as long as nobody wants their gold back, or nobody wants to withdraw it. Now hold on a minute. Not so long ago, we had a problem with the Bank of England because they were queuing up to take gold out because the premiums on COMEX were so delicious that you needed to, go and lease gold and then flog it into COMEX, and you could strip out, I don't know, $50 an ounce or whatever the premium was. I mean, what's not to like? So COMEX actually, if you like, drained all liquidity out of other centers, particularly London and Switzerland. And I understand that even liquidity in Mumbai was taken out by this arbitrage. So now put yourself in the shoes of a central bank, let us say, which has gold stored in London. It's going to say, I think, it's going to say quite reasonably, I don't want to lease gold anymore because I don't like what's happening. It's actually leaving the vault. Is it my gold that's leaving? I don't know. I mean, I think I'm going to stop this. I would probably want it repatriated, I will probably want some of it in London, but I don't want to lease it anymore. So the leasing game is stopping. That's the whole key. We've got no liquidity left in London or in Switzerland. New mine supply and scrap supply is spoken for big time by the Asians. I mean, they're just still hoovering the stuff up. Chinese insurance companies being the latest example. So we've got a liquidity crisis arising for the market because the supply, which the market might have expected from leasing, is drying up. So what does that do to things? Well, the lack of liquidity plus the lack of leased supply. And also bear in mind that the Bank of International Settlements very quickly closed down its position. Oh, like that. It saw this coming. So, yeah, I mean, I think we're in, as to the point about is this getting into a crisis, I think this is the beginning of a big squeeze on the Western derivative paper market, gold paper market system. And I mean, you could imagine that, if this does develop into a crisis, then it's the beginning of the unwinding of the entire derivative system. And we're talking here about trillions and trillions of dollars. I don't mean interest rate swaps because the principal is not involved in it, but things like foreign exchange positions and all the rest of it. I mean, you're talking about, several $100 trillion of liquidity, which is provided, systemic liquidity, which is provided by these paper forms of credit. And when that starts contracting, if that gets into difficulties, then it's goodbye our financial system. I mean, it's as simple as that.
I'm not laughing at you. I'm just like, oh my gosh, jeez. Wow.
We're not there yet. I mean, it's bad. I'm just sort of projecting possibilities, if you like.
Right.
Let's put it that
Well,
way.
let's game that out then. You mentioned at we'll end at this, the very start of this discussion, you talked about, it's anyone's guess how this ends up or what we'll go to or we're left with. I'm paraphrasing. What is your best guess as this plays out? Are we going back to a gold-backed currency again? Or are we just, what does this look like in your mind? The best?
Well, the only rescue, I mean, the only solution to this is to go back onto a gold standard. And the way to look at it is that, a mechanism has to be put in place whereby credit, the value of credit is securely tied to gold. And if it's not securely tied, then it's not good enough. It's desperately important that what we have today, which is failing, is replaced with something which is absolutely cast down. We know how to do it, or at least those of us who have studied the faults, if you like, of the Bank Charter Act in England of 1844. We know how to do it. It's actually not all that difficult. All this rubbish about there's not enough gold and all the rest of it, which the Keynesians talk about, basically means they don't understand credit. You've got to tie the value of credit. Now, the problem we have, I think, is that the people advising the system, if you like, don't understand economics. They think in terms of neo-Keynesian economics. They have to get off this ridiculous idea that gold is not money. Legally, it is money and has been since Roman times, since the 12 tables in Rome, 448 BC, declared the difference between money and credit. Tablet 7. It's all in there. You can Google it and have a look, and it's there. And it's been like that ever since. The Romans invented banking system, which we've refined, and we still have. So, in terms of resetting, as it were, there are so many hurdles to come over. And the other thing is, I think central banks are now very reluctant to let gold go. So the idea that a central bank will actually come up with a proper gold exchange standard, gold exchange for credit standard, is actually quite hard to envisage because of their attitude. They've got the gold reserves and they don't want to part with it. They would rather have some sort of sort of, if you like, fancy idea about, giving people the confidence that we've got enough gold to back the currency without actually having to back it, sort of thing. So we could go down some false alleys, things like CBDCs. Again, it's just another form of credit. So, we had something similar at the time of the French Revolution, before the French Revolution, which actually ensured the French Revolution was going to happen. They issued something called the assignat. And the assignat, it all started off as these things always do. We will do this once. They did it once, and it was so successful. We want to do it again. So they did it again. So, you can see the exponential curve, if you like, of the assignat supply increasing. And at the same time, obviously, its purchasing power is going down exponentially. And this was, I think, a major factor behind the French Revolution. You can imagine what a collapsing currency does to ordinary people, if you like, the peasantry, the people at the bottom of they start burning things and killing people and all the rest of it. So you had the storming of the Bastille on July the 14th, whichever year it was, and then you had the revolutionary government, which continued with the assignat because they couldn't do anything else. But then someone had a bright idea, would come up with a new currency, and it's called the mandat territoriaux. Sorry about my French pronunciation. Everybody cheered. It was the end of the assignat. But how long did the mandat territoriaux last? It lasted 6 months, and that collapsed as well. And I think that's almost a lesson for what's going to happen when this fiat currency system collapses. They're already trying to explore alternatives with CBDCs and all the rest. They will probably come up with a new version of paper before we actually learn the lesson. And there's also the political aspect of this, which was, presciently covered really by Hayek in his The Road to Serfdom, which is written really about how Germany went, from a currency collapse into Nazism. But it's the same human psychology. When you get something as horrendous as an event as a currency collapse, the political system will collapse with it. And guess what? You will get an extremist elected because people, we want a strong man. We want a strong man in there to run things. What do you get? You get Hitler. We got a sort of mini version of that with Trump, who's screwing up everything. Look, I don't criticize Trump for a lot of what he does. He's rescuing us from this woke rubbish. God bless him. But when it comes to economics, he is as ignorant, if you like, as his advisors. Let's put it that way. They just don't understand trade. They don't understand trade balances. And, they think it's the fault of the foreign that, US industry is on its uppers. It's not the fault of the foreigners. It's the fault of the Americans. And the consumers are making quite rational choices.
Mm-hmm. Yeah.
Looking at it from here in the UK, would I buy a Chevy or would I buy a BMW? Or BMW every time.
Right.
They're damn good. And not only that, but they are superior motors. Now what's going to happen is that, the American car industry is not going to have the competition that forces it to innovate. So I'm going to be even less likely to buy a Chevy.
Right.
I'm when I say Chevy, I'm just picking on a name. I'm not saying it's worse or better than any of the others, but the point is that you need the competition from abroad in order for your own productive capacity to innovate and compete. And if you have tariffs it's protectionism really, it stops that innovation. Every time. You don't need to be terribly clever to see it either. Yet I'm afraid that the current US administration is completely blind to it.
Yeah. So I had you on in a very opportune time, so I want to thank you for that. But I want to end on this is what exactly then, if this is the start of this and we're going into hard times, what advice, I guess, I would say over the next 3 to 9 months would you give to my viewers and listeners?
I tell everybody, get the hell out of credit. It's a very difficult decision because, everybody's been conditioned to think I've got to diversify my portfolio sort of thing. So, getting out of credit will be 5% gold and the rest would be, say, transports and bonds and whatever. But all that's credit. I mean, all that's credit. ETFs are credit. The only way out of credit actually is to have physical metal, physical gold. And if you want to speculate a little bit silver, because with a gold silver ratio currently running at about 95 or something incredible, I think that will probably come down as people begin to realize that it's the currencies going down, not gold going up. Because the same is true, though, as far as the central banks are concerned, they're not there buying silver. But this is also true of silver, which is an extremely useful metal. And I have no doubt that industrial demand makes this very cheap. I mean, the Silver Institute, for example, says that, the last 6 years, we've been in deficit, supply deficit. But then when you put in monetary demand on top of that, as gold goes up, and silver becomes poor man's money, if you like, that really could motor. It could be a better way to protect yourself than gold. And of course, it's all very well saying get out of credit, but we need to have income to spend, and that comes from interest on bank balances, on dividends from companies, bond coupons, whatever it might be. Speculation, I think, is probably not a good idea. But basically, I think arrange your finances in such a way that you can weather the coming storm, however that storm evolves.
Okay. Alasdair, can you please give me just where people can find you if they want to read more about you, read your articles, or do more business with you, or do business with you?
Yeah, sure. I'm concentrating totally now on my Substack channel, which is alasdairmacleod.substack.com. The Scots spelling of my name might be a bit confusing. But if you Google MacLeod Finance, it should take you there. So, the more the merrier, because what I want to do is to educate people about what's going on so they may protect themselves from these evolving problems.
Yeah. I'll put a link to that in the show notes, both on the YouTube channel, Apple, and Spotify. Alasdair, I want to thank you so much. Again, maybe we live in interesting times is the saying, and we are there, and it's been a very opportune time to talk to you. So I'm very grateful for that. Thank you so much.
Thank you very much for having me on.
Welcome.